All right, folks, as always, give me a second. Let me make sure that we're streaming live. Second one of these conversations I'm doing today. Should be a good one with Doug Peta. Do me a favor as we're live. If any of you want to ask questions during this live conversation, whether you're watching on X, YouTube, LinkedIn, we can see your posts, we can see your comments, which means don't hesitate to interact. I'll try and bring up your comments throughout this rough hour. This will be an edited podcast under Lead Lag Live on all of your favorite platforms, Apple, YouTube, and Spotify. And I'm actually quite excited for this conversation. I've had Doug's colleague, Mr. Peter Berezin, on a number of these podcasts. I'm curious to get his take on the macro, where we are today, and there's a lot of things which are changing, as I'm sure many of you are aware. So with all that said, my name is Michael Guyad, publisher of the Lead Lag Report. Join me for roughly 50 minutes is Mr. Doug Peta. Doug, introduce yourself. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
Sure. So I am the Chief U.S. Investment Strategist at BCA Research. BCA is an independent research provider that is top down. So that's what's really different about us is we analyze the world's major economies for insight into where financial markets are going, as opposed to analyzing individual companies to try to figure out where markets are going. I began in the business as a trader on the sell side. I've been at Merrill Lynch, I've been at Lehman Brothers, and then moved over to the buy side as a trader of Asian equities from New York City, and eventually went straight and went into research as a financials analyst and as our sole macro person. I was our strategist at J&W Seligman. I guess I'm a lifer in this business, Michael, because in 2007 and 2008, I was the sole macro person at that mutual fund family. And I was also our lead financials analyst. So everything was my responsibility from either the bottom up or the top down. And I'm still here. In fact, I really enjoyed it. So I'm afraid I'm stuck with this for life.
What years were you at Merrill and then Lehman?
So Merrill right out of business school in 98, 99, then Lehman 99 through 04, Seligman 04 to 09, and then BCA for the last 15 years.
How does research at the major wirehouses differ from research that BCA puts out?
It's nice to be here because we can be totally independent. Since we don't underwrite securities, since we don't manage money, whenever I'm in a meeting with a client, I am not getting kicked under the table by the sales team saying, hey, dude, come on, we're underwriting this deal. You can't be saying negative things about this space. We are completely free to say what we believe. So what's great at BCA is we're really selling our thinking and nothing else. It's not the out, because we don't have any particular stake in the outcomes. We only have a stake in getting it right.
As you know, it's a lot easier to, in quotes, get it right by being optimistic and bullish because markets tend to go up over time, economies tend to expand over time, and you tend to have more up days than down days. Admittedly, though, it's a lot easier to build a name if you can get the downside right. If you can get that call right, because it's the odds are kind of against you just in terms of time. So with that said, I know Peter Berezin, for example, has had a more cautious view on markets, on the economy. I happen to agree with a lot of things that he said. Now, I don't know if a Trump administration changes that or not, but let's start with the top down. Where are we in terms of the business cycle? Where are we in terms of the potential for recession? I named this conversation, is recession even possible anymore? Because it seems like we've forgotten what it's like.
So, let me just before I directly answer your question, just wholeheartedly endorse the view about it's really hard to be bearish. As you said, the natural tendency of the economy is to expand. Therefore, the natural tendency of corporate earnings is to grow. And if you hold the multiple that investors pay for those earnings constant, and we all agree that multiples are a mean reverting series, then equity's natural tendency is to appreciate. And you said we go up more days than we go down. I've actually counted because I am a macro nerd. If you start with the recession that began in December 1969, so we start with the recession, so we have a recession, expansion. 89% of all months, the US economy has been expanding. If you start with the S&P 500 bear market that began around Thanksgiving of 1968, 82% of all trading sessions on the exchange, we've been in a bull market. So I do not go negative lightly. I have a much higher bar for underweighting equities and risk assets than I do for overweighting them. However, we do think now is the time to do so because we do believe that a recession is nearly at hand, and markets seem to have decided that a soft landing is all but a certainty. So that's sort of the backdrop. It is, I think investors, long-term investors and asset allocators should go underweight equities and other risk assets sparingly and fleetingly. You don't do it very often, and when you are underweight, you're watching the door and you're looking to get out of that as soon as either it's worked out for you or you have some sort of stop loss. And even if we continue to hold this fundamental view, we'll stop ourselves out at 6,100 on the S&P 500 and wait for a better entry point. So that aside, that general principle. Where are we in the business cycle? We think that we are heading towards an inflection from expansion to recession. And I think a very important point in our analysis that markets don't seem to share is that we're in the midst of a 4-year story. This story started 4.5 years ago when the Fed embarked on extraordinarily accommodative policies to try to protect the economy from the pandemic, and when Congress did the same with fiscal policy. There were monumentally large fiscal transfers from Congress to Main Street, and they were really powerful this time because those fiscal transfers went into the hands of households who were likely to spend them. If you lower the top marginal tax rate, you're going to see money silting up in these folks' brokerage accounts, but it's not likely to be spent because all economists believe that wealthier households have a lower marginal propensity to consume. If you give them $100, it's going to go into their brokerage account. If you hand a $100 bill to a family that's just getting by from paycheck to paycheck, they're likely to spend that immediately. And those fiscal transfers went to the bottom 7 deciles of the income distribution, because to get the direct payments, if you were a single taxpayer, you could not have taxable income of more than $75,000. If you were married filing jointly, it was $150,000 or less. That's 7/10 of America. Then, because the folks who bore the burden of unemployment, for the most part, were unskilled services workers, the federal unemployment insurance benefit supplement payments, I would wager, went to the bottom quintile, the bottom 20%, or the bottom quartile. So you had $1.5 trillion of money going from DC to households to offset what we estimate was $300 billion of lost wages. That created a lot of spending power for households. We called it excess savings. And we think that drove the positive surprises in 2023 and 2024 when the consensus was certain we were going to have a recession by the middle of 23. But now that tailwind is waning and about to cease entirely at some point in early 2025, we think we are set up for a recession because this 4-year tailwind is beginning to abate.
Let's talk about economic data points that you're looking at that tend to be leading indicators. I often find that traditional media will reference indicators that are much more coincident and lagging. What are some of the leading indicators that make you more and more convinced of that scenario?
They're really pretty much concentrated in the labor market. So we're looking in the labor market for indicators that lead non-farm payrolls. And if you'll let me digress a little bit, back to this notion where we are in the business cycle in this 4-year story. Look, we know that the United States is heavily driven by consumption. It's 2/3 of GDP. I'll broaden that out to say that I believe the central theorem of macroeconomics everywhere in the world is that my spending is your income and your spending is my income. This is how Keynes gets to his paradox of thrift. If we all try to save more, well, that's why we all save less, because we'll earn less. We'll have less to be able to save. So consumption has been essential for us ever since the pandemic arrived here. And that you need income to consume. All of us need income to consume. There are three temporal buckets, three time buckets from which we can spend. We can spend out of past income. That's income we've earned in the past, but we haven't spent yet. It becomes our wealth, right? Those are savings or investment. We can spend out of present income. That's compensation and investment income. But recalling the marginal propensity to consume point, since almost all the financial assets are held by the wealthiest households, I'm going to look through investment income. It's really compensation that's going to be the big driver of that present income bucket. Then there's future income. We turn future income into consumption today by borrowing, because when we take a mortgage or an auto loan, we're promising that we're going to direct some of those future funds to service the debt and ultimately to pay it off when it matures. I'm arguing that we've been getting a really powerful tailwind from past income, and it's going to go away. I'm further arguing that that future bucket is not going to be able to plug that gap, because we've heard for 8 consecutive quarters from the Senior Loan Officer's Opinion Survey, the SLOOS that Chair Powell refers to, that banks have been tightening consumer lending standards. Additionally, that same survey has told us over the last 8 quarters, there really hasn't been much demand for consumer loans, which makes sense because they cost 5 percentage points more than they did 2 years ago. So I would argue that that future bucket, it may give us a little bit more of an impetus for consumption, but it can't begin to fill in the really sizable tailwind from past income. That puts the onus squarely on present income and therefore on compensation and the labor market. So what are we watching within the labor market to tell us when payrolls growth is going to soften enough that we're going to see consumption flag? It starts with the JOLTS. I'm going to list 7 indicators. With the JOLTS, there are 3 of them, and JOLTS stands for Job Openings and Labor Turnover Survey. The job openings rate, the job quits rate, and the job hires rate. All 3 of them have come down considerably from late 21, early 22, when we had a big mismatch in the labor market. We had way more demand for human inputs than we had supply of them, particularly when it came to unskilled services jobs within leisure and hospitality, be it restaurants, bars, check-in at the gate at the airport, check-in at the front desk of a hotel. The openings rate is still fairly elevated. As of the September data that we got at the beginning of October, we got it at the beginning of November. Openings are still 0.7 of standard deviation above their mean. So, more than the average, not crazy high, and they had been 3 standard deviations above the mean, but nonetheless, sort of elevated in level terms, although the direction is quite clear. The direction is the same for the hires rate and the quits rate, but in both cases, the levels are below the long-term average. The quits rate is 0.3 of the standard deviation below its mean. The hires rate is 0.5 of the standard deviation below its mean. When I look at the quits rate, I think of that as telling us about relative leverage between employees and employers. When the quits rate is really high, when it's 2 standard deviations above the mean, it meant that employers were poaching people from one another. So it was really easy if you were a savvy employee to get a double-digit raise just by walking across the street to a competing establishment. And many, many people did. But the hires rate for me is where the rubber really meets the road for what's coming for payrolls, because before you lay people off, you might decide simply to slow down hiring or even implement a hiring freeze. So we have seen layoffs be very, very low. Initial jobless claims remained low. But we don't have payrolls growth, which is the net of new jobs and people who've lost their jobs, job creation and jobs destruction. So job destruction has been real mild, but job creation isn't really doing much. And I think that's what the hires rate is pointing to. When we put those three series together, all clearly decelerating, and two of them at a soft level and one at a fairly robust level. In the aggregate, we see the jolts pointing to continued deceleration in the labor market and therefore ongoing pressure on compensation. And I talked about payrolls before, but compensation is really the product of non-farm payrolls, average hourly earnings, and average weekly hours. You don't need any of them to contract, but if they're growing between 0 and 1%, or even 1 and 2% nominally, that can be enough to chill consumption growth.
Can,
Okay,
can
so
I interrupt? Can I interrupt for a second? Because I think this is interesting. I mean, clearly, I think we're talking about after-tax compensation. I mean, so to the extent that Trump follows through on tax cuts, how does that potentially change the calculation there?
to me, it comes down to the impact of tax cuts comes down to who gets them. And it returns to this marginal propensity to consume concept. More cuts for the top of the income distribution, while my wife and I would welcome them, and while all of our clients would welcome them, I don't think it's going to do anything. It's not going to move the needle. It would have to be cuts for the broader mass of the American people. And when you talk about, like, all right, exempting tips from taxes, when I was waiting tables, I wasn't exactly reporting all my tips. And none of my colleagues were. That we got paid $2.01 an hour or $2.10 an hour. And then with tips, I was making $8, $9 an hour, which wasn't bad money in the late 80s, early 90s. When we got our W-2 from the restaurant, it had this imputed high fours, low fives per hour is what it said we were getting in tips. And I followed that right through to my 1040. So while tipped employees would generally fall under that higher marginal propensity to consume umbrella, you have to realize that not all these tips are being declared to begin with. So I think there's less there than would meet the eye if we were to exempt income from tips from taxes. And then, look, you could, if we're going to pair tax cuts with fairly punitive tariffs, tariffs are a tax. And if they get passed on by businesses to the ultimate end consumers, I can see a scenario where the headwind from tariffs is greater than the tailwind from taxes. As a matter of fact, that would be my base case scenario if we have anything like a 60% tariff on China and say 10 or 20% tariffs on all of our trading partners. So I do not see tax cuts as being something that can really jolt the economy. At the corporate level, look, it was great when we went from a 35% rate to a 21% rate. And that was at the end of December 2017, that law was passed. You could see S&P 500 earnings make a step function move higher in calendar 2018. However, if we're going to go from 21 to 15, there's less bang for the buck there. And so you shouldn't expect the same boost that we got in 2018. Bottom line, I don't think tax cuts will really change the picture all that much.
How does a shift in immigration policy shift the jobs picture? Because I think that's sort of you can argue, one of the, in quotes, mandates that got Trump elected.
It's a little complicated. Let's just talk about, and I think it's complicated because there are countervailing forces here. There are puts and takes. If you were to have meaningful deportations, if you're going to have mass deportations, that would mean that you are going to presumably remove some unskilled services workers from the supply, from labor supply. Well, all else equal, if you reduce supply and demand is unchanged, prices go up. So on the one hand, the people who replace the workers who wouldn't be here anymore, they'd get jobs. But I think there's a case to assume that they'd have to be paid more because, even though we may have $15 an hour minimum wage laws in a lot of states, if you're undocumented and the employer knows that, then maybe you guys reach an agreement at $10 or $12 an hour. So I think it is fair to assume that citizens and documented immigrants get paid more than undocumented immigrants, especially at this lower end of the wage scale. Good for consumption, bad for corporate profit margins if businesses can't pass on those higher costs. Inflationary no matter what. So I think yes, could be a boost for consumption, but likely to weigh on corporate profit margins and corporate profits, and therefore all else equal stock prices, and also could be inflationary, which would be negative for the entire gamut of financial assets.
Equities are supposed to be a leading indicator, and they haven't really been suggesting trouble just yet. I say supposed to be because I'd argue that with automatic passive flows, at least the S&P has become much more of a coincident indicator of income than anything else, as 401ks keep on auto buying market cap weighted Vanguard type of proxies. Is the stock market in quotes wrong about the future?
It can be, right? It's not the
It's wrong
gospel.
plenty of times historically. That's what people forget. Right?
Right. Like we always, every bear market begins at a peak by definition, just like every recession begins at peak output. I still believe that financial markets are generally leading indicators, but they're driven by this fallible species. And so, the species does often get things wrong. I, you I don't have a crystal ball any more than anyone else. If I did, we'd be doing this from my yacht, um, or the Wrigley Field bleachers if it was still baseball season. But what we can say for sure, what we can say objectively, relative to history, equities are awfully pricey. The S&P 500 is trading at between 21 and 22 times its forward four-quarter earnings expectations. And it's been to 25 during the dot-com boom, but 23 is 2 standard deviations above the mean, which randomly you would expect to only occur 1 out of 40 times. So if you're buying the S&P at 23 times forward four-quarter multiples, you are on the side of the 1 against the 39. And I think it's more likely to work out well if you're on the side of the 39 versus the 1. We all know in this business that valuation is a notoriously horrendous timing indicator. Stuff that's expensive can get more expensive. As Keynes said, the market can remain irrational longer than you can remain solvent. But I do think the risk reward as we get to really elevated multiples argues against equities. And I'll tell you, even if our fundamental call isn't correct, even if there isn't a recession coming in the first half of 2025, I can see the investment strategy recommendation to be defensive that's built off of that call working out even if the economy has a soft landing, because we are trading at between 21 and 22 times four-quarter earnings when calendar 2025 earnings are projected to grow by 12% over calendar 2024. That's pretty darn high. The average is 7% in the post-war era, and 7% would most certainly be consistent with a soft landing. But the distance between 7 and 12 isn't nothing. So you've got really pricey multiples for the S&P 500 and pricey corporate bond prices when we've got tight investment grade spreads and really tight high yield spreads on top of ambitious earnings expectations that would be really unusual if we were to hit them this far into an expansion. Could happen, one thing that's changed this week is that it is not impossible that consumer confidence and CEO, CFO confidence could rise enough that we see a pickup in aggregate demand that is enough to stave off a recession, that is enough to reverse what we see in the softening labor market. That could happen. It's not my base case. And given that, again, we've got really pricey multiples on top of ambitious earnings expectations, it's going to be really difficult, to my mind, for S&P 500 earnings to surprise to the upside, and therefore for equities to have a fundamental reason to move to the upside. Animal spirits are animal spirits. They can do, again, can be irrational longer than you can remain solvent. However, there's a whole lot more room for that to happen when the multiple is at the mean just below 15 than when it's almost 2 standard deviations above that mean.
You said you used the term "be defensive." I feel like we should define what defense is. I have always made it a point that there's really only 4 fairly consistent, in quotes, risk-off assets: the dollar, gold, utilities, and then used to be the case, long-duration treasuries. What's your definition of being defensive?
I'll tell you, I like those assets, especially with the caveat that used to be long-term treasuries. My definition of being defensive is underweighting your benchmark in equities, underweighting your benchmark in credit. So if you are a multi-asset investor with, I'll just make this up, but these I think are reasonable, with say 60% equity, baseline equity allocation, 35% baseline fixed income allocation, and 5% cash allocation, then you want to be below that equity benchmark, above the fixed income, but above in treasuries or other developed world sovereigns, and underweight what we call spread product, credit, anyone that isn't as likely to repay their debts as a top investment grade rating, top investment grade rated developed world economy. Within equities, like you're saying, look, utilities are one of these defensive plays. If you are an equity manager, being defensive means overweighting utilities, consumer staples, healthcare, underweighting late cyclicals like energy, industrials, and materials that are particularly tied to the business cycle. If you are a fixed income manager, like I alluded to before, it's going to the sovereigns as opposed to credit, so rates instead of credit. And then within credit, concentrating your portfolio more with higher rated credits than with lower rated credits.
I've been waiting for a year plus to see credit spreads meaningfully widen, and I am still waiting. Every time it looks like they want to blow up, there's like a whack-a-mole moment by the Fed where they're immediately saying something or doing something that knocks that down. What's required to get spreads to really blow out? And when I say blow out, what I'm really saying is something that really causes panic. I mean, I had been of the mindset for the last year that Japan would be a spark for credit event through the reverse carry trade. I was very adamant about that on X. Played out for 2 trading days, right? And then everyone forgot about it afterwards. I actually still think that is more of a preview of what could be coming, not because I'm a perma bear, but it shows you of how interconnected deleveraging shocks can be. But what's it going to take? I mean, it just seems like every time spreads want to go, they just don't.
I think a recession would be what it would take. If we get that inflection in the business cycle and we go from expansion to recession, what has always happened historically is that default rates have picked up. And when default rates pick up, then spreads widen to reflect it. Before you would have the defaults, you'd have a pickup in delinquencies among consumers. You would have a pickup in delinquencies among corporate borrowers. So I think it all comes down to, and let me mention, BCA, we don't particularly care about the economy. That's not our job. The economy is only a tool for us to forecast financial markets. Well, if we have a recession, when we have recessions where the rubber really meets the road for risk assets, we have S&P 500 earnings contract. Okay? Every single time, except for the first leg of the Volcker double dip from January to July 1980, when you have a recession, you have trailing four-quarter S&P 500 earnings fall by double digits from peak to trough. Well, and typically it's around 20%. Now, we think this recession is going to be mild, so my best guess is 10 to 15% contraction in earnings. But if you have that 10 to 15% contraction in earnings, and it's accompanied by, say, 3 multiple points coming off of the forward PE multiple that's now between 21 and 22, let's take that down to 18, which would still be elevated, which would still be about a standard deviation above the mean. Well, 3 multiple points on 20 is 15%. So take a 10 to 15% decline in S&P 500 earnings, take a 15 percentage point decline or 15% decline in the multiple, you have a 25 to 30% decline in the S&P 500. And I think that merits, if you believe that's coming like we do, that merits turning defensive even within my sparing and fleeting framework for underweighting equities. As that relates to credit, earnings go down 10 to 15%, the borrower you lent to is now a weaker credit than it was when that loan was underwritten, either by a bank or when the bonds were issued when you bought it. Because you didn't foresee this, when you made that loan, presumably, you didn't project this unusual decline in earnings, which typically only accompanies recessions. Less earnings than expected, more difficult to service the debt and ultimately to pay it off when it matures. Spreads should widen to reflect that. So that to me is the way the hip bone is connected to the leg bone, et cetera, for the business cycle and credit spreads, and indeed the business cycle and equity performance.
And of course, all this is connected to inflation expectations because spread widening tends to not occur when you have inflation expectations rising, because the idea is you're inflating away that high risk credit. So let's talk about the inflation outlook.
We believe that independent of a recession, disinflation is intact. So what Chair Powell has been describing in his press conferences for a while, and will presumably repeat this note this afternoon, that, look, we still think there are disinflationary pressures in the pipeline. Overridingly, because we believe there's plenty of shelter disinflation in the pipeline. Apartment units, multifamily units under construction but not yet completed has dipped below 3 standard deviations above its mean, but it's still more than 2 standard deviations above its mean. And we got from 3 to 2 as units got delivered, but there's still a whole lot more in the pipeline. If demand doesn't change and supply goes up a lot, prices fall. Shelter is a little more than 40% of core CPI. So there's the biggest factor driving core CPI is poised to continue decelerating. And we think that will show up in core CPI, core PCE, where shelter is about 30%, a little bit less. But we think you're still going to see downward pressure on inflation, even as the expansion plays out. If we get a recession and you have this decline in demand, but there's still supply out there, prices fall, and you'll have even more downward pressure on inflation. But we do think the inflation outlook is pretty benign, pending what we get from the new administration. And I'll just mention, we touched on this before, but the 3 big planks on the campaign trail for President Trump and soon to be Vice President Vance were tariffs, tighter immigration enforcement, and tax cuts. And all 3 of those individually are inflationary. So it is possible you could get a mix of policy prescriptions from the new administration once we get into 2025 that offset that downward pressure in the pipeline from shelter, and we could see inflation bottom begin to turn up. Presumably, that's a part of the backup in the 10-year yield that we've witnessed from 360 to 440. Right? An 80 basis point backup is pretty meaningful, and it seemed to track the fortunes of the Trump Vance ticket in the prediction markets. So I do think there's some correlation there, and that we could potentially see some inflation pressure from the new administration, but we all have to remember that candidates say a lot of things on the stump that don't happen when they come to office. So I think it's sort of wait and see, and maybe the Treasury market has done about what it ought to price in the probability that some of those inflationary measures would be put into practice.
There's rumblings that China's going to have to step up its game as far as stimulus because of tariffs and other dynamics from the Trump administration. How does China play into the inflation thesis? So I think if China does somehow succeed at reaccelerating, that's going to put upward pressure on commodities. Here comes cost push inflation.
I think that's true, although it's not true to the extent it would have been, say, 20 years ago, when China had this voracious appetite for base metals and anything involved in building infrastructure. And if we can go back to 20 years, 24 years, right, in the early 2000s, that decade, in retrospect, a great way to invest was to invest in what China needed, whether it was iron ore, copper, et cetera, et cetera. And the picture is different now that the Politburo and other policymakers in China confront a world in which they've got zombie properties. They've got way more residential properties than they need. The Belt and Road Initiative seems to have faltered. Now, China hasn't entirely abandoned that program, but you do see articles with bridges to nowhere in several developing nations where the money ran out or just China ceased to continue construction on some of these things. So I think there is less demand for commodities from China this time around, and therefore less of a tailwind for the Australias, the Brazils, the resource economies out there. And at the individual stock level for materials companies, which generally aren't based here. But China surely does matter for the rest of the world. And my 30,000 foot quick and dirty view of how China impacts the global economy is via its import demand. Right? China's imports are the rest of the world's exports. And this gets back to my spending is your income. Right? China's spending is the rest of the world's income. Beginning in 2000, it was very much resource economies income. It's such a big country and a big economy, that if you were to see spending, consumption really pick up, consumer demand really pick up there, it could boost demand globally. I just think the beneficiaries of it would be different than it was the last time, because again, I don't think it's going to be centered on resources, but we do have to be aware, to this point, Chinese policymakers have not much been able to stimulate consumer demand. They surely see that, our economy would be more stable if we could shift more from investment to consumption. But, for now, that horse, they may have led that horse to water, but it hasn't been inclined to drink. So we will see. But I do think you're right. If the new administration were to impose pretty harsh tariffs on China, it would have to step up its domestic stimulus. And it is possible that we would see that flowing to the rest of the world in a pickup in global aggregate demand. But remember, if we do impose unilateral trade barriers, they're going to become bilateral pretty quickly, right? The other side will retaliate. And if the US is to impose tariffs on all trading partners, well, presumably they're going to strike back in a tit for tat response. And that, I would argue, because we said earlier, tariffs are a tax, that would be a headwind for the global economy. And if you had restrictions on trade broadly around the whole world, that my best guess would be that would outweigh whatever Chinese policymakers would do, given how reticent they have been for the last couple of years about doing anything meaningful. It does not seem like they want the irrigation stimulus, the huge stimulus that they embarked upon in 2008 to try to protect China from the ravages of the financial crisis everywhere else in the world. So if they're reluctant to make a big move and will only do so after they're forced by a crisis, that's not great for investors in risk assets, and you'd be better off waiting for the crisis to occur before you got long China and China-related plays.
Is there an argument to be made that, I mean, I understand from a probability perspective, it may not be high for you, but, make the very optimistic case that we're in sort of a 90s boom period?
We could. Remember, the 90s experienced a productivity boost from the PC revolution, from personal computing. And the economy's a complicated place. I always like simple examples. I got out of undergrad in 1992 and went to work for Arthur Andersen, which at the time was the world's largest professional services company in the world. When I got to my cube on whatever floor we sat in the Georgia Pacific building in Atlanta, I met the woman with whom I was going to share the cube. She was senior, I was junior. And we each had a monitor on our desk. But between the two of us was this box with a knob that you could turn to A to B. And if I wanted to use, so we had two monitors, but one hard drive. And if I wanted to use the computer, I asked Kelly, are you using it? She said, no, I turned the knob from B to A. Additionally, each side of the floor had one printer. It was on wheels, so if you wanted to print, you rolled it into your cube and then got down on your knees underneath the desk and hooked up the printer to your hard drive. Well, as the 90s unfolded, eventually everyone had their own computer on the desk. We had printers for every 4 cubes, et cetera, et cetera. It's hard to see now what could have that sort of impact on productivity in advance. And maybe you never see these things in advance, and the species has been great at generating them over time. But I think the jury's out on that. Absolutely, it could happen. If I'm going to position for that, I want an attractive risk reward. So to position for something that's improbable but could have a really big impact, I'd like to see better odds. I'd like to see the S&P 500 forward multiple be at its mean or below it. At 21 to 22 times, man, you really need that to happen. 21 to 22 times when we are pricing in 12% year-over-year earnings growth in calendar 2025, I would suggest that the probability of that sort of moonshot productivity boost is greater than is likely to occur, and that your risk reward is better to bet against it. Though it could happen, and look, I'm an optimist 3 times over. I'm American, I'm an equity investor, I'm a non-native New Yorker. So I do believe you shouldn't bet against this species, but you can make more money if you put your chips down when you get better odds.
Doug, for those who want to track more of your thoughts, more of your work, and learn more about BCA, just talk about the various ways people can reach out to you.
Sure, you can get in touch through bcaresearch.com, and we will be happy to set you up with a trial for my team's work, which is U.S. investment strategy, or anything else in the global financial markets that you think would be relevant. We attempt to cover every single meaningful asset class around the globe. The only thing we don't have is dedicated Japanese coverage. but we cover commodities, we cover global fixed income, we cover Europe, we cover the US, we cover emerging markets. It really is sort of a soup to nuts coverage of the entire global financial market. And again, we use analysis of the global economy to do that. But just reach out for a trial at bcaresearch.com, or if you have had contact with a salesperson, get back in touch with them. And we'll be happy to set you up and have investors evaluate our thinking. I mentioned before, what we're selling is our thinking. Now, I think right for the wrong reasons shouldn't count in this game, although it often does. But especially in our seat at BCA, gotta be right for the right reasons. So take a look and see if you like the process, if you like the analysis, if you like the rationale.
Appreciate those that watch this live stream. Again, this will be an edited podcast under Lead Lag Live. Please help me keep that momentum going that I've got. Top 5% most downloaded podcasts out there. And hopefully I'll see you all in the next episode. Thank you, Doug. Appreciate it.
Thank you very much, Michael.